Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, January 14th, 2022. I wanted to do this one now because I just wanted to get this out there. I think it's an objective time to add some short exposure, to maybe take some shorts, and I wanted to also get it out well in advance for the weekend because a lot of people always ask, "Hey, Randy, it's Friday. As a swing trader, you have an extra 2 days of overnight risk. Overnight, anything can happen." And as we head into the weekend, whatever you take home today, you're stuck with. And if it's futures, until at least Sunday night. And if they're equities, then you have to wait till Monday morning. So, anything can happen. Markets are going to gap up or gap down. They usually do over the weekend. And anyways, I'm going to go over the levels that you decide what to do. I'm just going to revisit this chart. I've covered it in the past. This is the Skew Index. The Skew Index measures tailwind risk in the stock market, and it's been used and often referred to as a market crash indicator, or predictive of big drops. And it's had a pretty good record. I mean, we can go back all the way in time, but what I wanted to show you here is just basically where we're at, where it is relative to its typical value. We're coming off all-time highs on the Skew Index. You remember we had that big fourth quarter drop back in 2018. That was clearly warned of by the Skew Index. Even if we fast forward here, sorry about that, I'm scrolling all over the place here. If we pull forward, it even came, heads up for COVID. When COVID first hit, really took hold in the markets. That was in February of 2000. They started dropping. It was quick. 36% drop in the S&P 500 happened over just 6 weeks into the March lows, but it was predicting that right here towards that was about the end of the year in 2020. And then we had a little abatement in the Skew Index, so the market kept going up, and then it peaked right here, and this is where that's where that drop started in when COVID hit. So you can see that, and this is similar what's happened, but on a bigger scale. We hit this all-time high right here last summer, and then into the fall we had another big spike, and we're making a lower low. So this to me is indicative. You get these usually and almost always before the actual top is in. You get a big spike and then a lower spike, and kind of like divergence, if you will, between the stock market continuing to go up in each instance and that. So look, you guys know my thoughts on the market. I think we're gonna, whether it happens soon, and I think that's it. And that's why I want to do these videos. That's why I keep these updates. Sooner or later, it's going to be the last chance to get short while it's still objective and not chase. I don't. That's just me. I don't want to short. I won't be telling you it's objective to short down here. If we hit my 360 target, we're probably going to bounce. We could run right through it. But the way it works is, the deeper you get down into correction or bear market territory, the stronger the more oversold you get, because stocks tend to fall a lot faster than they rise, and so you get really oversold, and then you get short covering rallies that are very powerful. And so I'd rather short up here where the risk reward is very attractive, meaning a lot of downside, and then you can keep your stops. It's easy to quantify your stops and place objective stops based on technical levels. And so I'm going to just go over where we're at today on the markets, and maybe cover a couple other trade ideas for you. Okay, so let's start out here on this weekly time frame of QQQ, and what stands out to me the most is this trend line I've been watching and highlighting for a while, and we're below it, and we're also below that 387. Remember, this 387.86-ish, we'll call it 379. It defines the bottom of this trading range right here that we've had recently, and we're below it now. And again, the day is young, so you have up until 4 p.m. today to decide what you want to take home, or really 5. You want to trade after hours, and futures will go. And then, but you want to, everything's most liquid during regular trading hours. So you can wait and see what happens. If bulls manage to ramp this thing up higher, so far they're buying up the open. But again, as I'm doing this right now, we're still below that level. And so as we head into the, towards the close today, if we're below that level, and as I like to say, the redder the better, meaning we get down here, the higher chance we're going to have that that breakdown sticks. And I'm talking both the breakdown of the uptrend line, which is very well, we're well below that now, and ideally because we have very good price support there, probably as important, all these recent lows, that's what I call my BOD, or benefit of the doubt trend line. In other words, you're going to short during the strongest bull market in probably in history. You want to give it the benefit of the doubt. You want to have those sell signals. And again, when I say short, it can be a hard short or it can be a scale in. You know me, I like to scale in, scale out of swing or trend positions, and I've got some pretty aggressive targets here. So, I'm layering into, and we'll increase swing shorts if we get those additional check marks, and that'll be one today. So that's kind of the takeaway of this video. Let's see how we close today. Now let's jump all the way down to the 60-minute chart and show you what's going on there. So far, if we strip away all my annotations, all the lines, everything else, you can see we are in although the long-term trend is bullish, intermediate term trend is bearish. This is a downtrend. We're working our way down here. It's not a super well-defined channel, but you can see we keep making lower lows, and so that's why it's so important. When we take out this low today, it becomes even more clear to both bulls and bears. Bulls meaning those that only want to go long, only buy long trades, and bears meaning, again, I'm referring to sellers versus buyers as a whole, but flexible traders like myself that will go long or short, they're going to see that, and so you're going to have longs that may stop out, or undoubtedly will stop out. There'll be some stops set under that previous reaction low, and you'll probably have more short sellers come in. And if it happens a lot of that at once, which I think it has the potential, it could be a pretty big drop next week. So I'm not expecting any fireworks today. I'm always on standby for anything and prepared to, traded long enough that never say never. Anything can happen any given day. But usually in a weekend, traders kind of lighten up their positions. So they'll probably leave it hanging today. And I'll let you know by the end of the day. But as of now, like I said, I just wanted to say that I favor going home short in the weekend. Absolutely. We're a lot closer to the bottom of the recent trading range. Here, let me turn off everything again, than we are to the top of it in both SPY and QQQ. So, you have trading range here, a little dip below there, we're fighting to recover that now. But again, we're closer to the bottom of it. So the risk right now, in my opinion, going home for the weekend is being long. Why? Well, because there's no way we're going to gap up this high on Monday. There's no way we're going to close this right now. It's just too far to get to the previous highs. Or let's say the all-time high right there. It's about over 7% from where we're at right now. So that's not going to happen. We're not going to gap up, but we could certainly gap down. So again, you can gap either way, but you're not going to break out. In other words, another way for me to try to explain what I'm saying, there's absolutely no way that any bullish technical events, significant technical events, can possibly happen between now and Monday. The markets would have to, and they're not going to do it in this environment, put some crazy 5+% rally on today and then gap up on Monday. So anything else in there in that range is just noise. There's a mountain of resistance overhead, and so far the trend since the Nasdaq 100, the index that I'm most focused on, peaked back in the middle of November. It continues to move lower. So that's it. There's my thoughts. Trade as you want. Honestly, if you're not comfortable with shorting, or you're not comfortable with being long or short, be out of the market right now. It's one thing I can tell you with certainty: if volatility is not your cup of tea, this is a great time to stand aside. The volatility is expanded. And the other thing I'm noting too is I showed you the Skew Index, and the Skew Index is somewhat related to the VIX, the VIX Volatility Index. It uses put and call buying, and the VIX has been non-responsive. So you might say, well, okay, Randy, that's usually the VIX goes up when we're correcting. Well, this is complacency. This shows me the put call ratio, that the market as a whole, market participants are complacent and they're not worried. They don't see what I see. I see the market sitting on the edge of potentially on the edge of a technical cliff with some long-term, we're going to get a weekly sell signal here, quite likely today at what I just covered in the beginning. That's QQQ. Again, unless they can ramp it up hard into the close today, might get a stick save. And on the weekly, here's SPY, the S&P 500, still below this trend line. Broke down, it's been back testing, starting to roll over. So again, I think it'll become clear if we take that out. And again, I also think we'll see at some point, and when that happens, I've been talking about the risk of a sudden rush for the exits for a while. But of course, you need to take out the support level. And the more that we go sideways, I always talk about these sideways ranges as similar to being like a energy like a coiled spring. You get a trading range, and when it's well defined, you break to the upside, and that's very bullish, and that usually sets the next trend. You break to the downside, and that's bearish, and that usually sets the next trend, next tradable trend where you can position and either hold out for your price targets or just set a trailing stop and let it run. Sit back and watch your account, go up in value. And so that's it. Let me leave it there. This is the NQ Nasdaq 100, the 2-hour candles. This is the one I showed you last week when we reversed right here for active traders. And I said swing traders can, if you're not an active trader, you're not very nimble, then just ride out the counter trend bounce. And active traders, I said you can game a bounce. And that's what we did, back up to that levels where I did. Or you could have trailed a stop up, and that would have kept you long because we went up most of the time till right there. So you would have been able to A, lock in book profits on your shorts at that point in time, B, turn around and make a profit on a long trade, whether you took it here or all the way up, and then get back short again. We just hit resistance on QQQ yesterday or the day before, and so far we're down, and you're almost back to where you were too if you are a swing or trend trader and you wrote it out. So again, we had multiple shorting ops here, all these pushbacks to that resistance up there. This is where the most objective shorts and numerous short entries were laid out. And now these are my next targets on the NQs, looking at this chart. And I think we'll come all the way down here. And I think we'll be there next week, by the end of next week. If things play out the way I think they do. And what that means is what I just showed you earlier today when I got that chart out. You've got to take out these lows in NQ and ES. And whether we do it today or next week, when it happens, I think that's where the floodgates will open. You'll see a sudden rush for the exits. And again, I do this video because it can happen quite likely on a gap down. That's how the markets like to work. They like to trap longs and deny wannabe shorts that are waiting for the perfect green light, the perfect entry in. So again, I'd rather be wrong and stopped out than not be positioned short for the potential that we're going to gap down. Now, if anything happens by the end of the day, some crazy rally puts us back well up here, and then I might temper my, and I might reduce my short exposure or not add to any before the close. But as of now, again, that's what I'm seeing, and that's what I'll be looking for today. Okay, and just step in that same chart, we're still in NQ down to the hourly chart. This is you can see the level right there, clear as day. And this is why I wanted to do the video. We just kicked back. We're back testing. We broke that level this morning. At the open, they gunned it. Dip buyers, just like Pavlov's dogs, have been stepping in. It's hard for them not to, because for so many months or over, a couple of years now, really, or over a year, I'm sorry, since no, 2 years, coming on 2 years. Sorry, COVID. Gosh, it was March of 2000. When the Fed flooded the system with stimulus, as well as the federal government putting money in everyone's pockets, grossly overreacting, in my opinion, to the the situation. And it worked, but it looks like it's drying up. That stimulus, and the thing is, they're turning off the spigot. In my opinion, and some others, way too slow. But at least the Fed is finally turning off the spigot, and so is Washington. The stimulus has been drying up. So that's that, guys. let's not talk about it anymore. You take it, don't take it. If you short, well, we got rejected at 1600 on NQ recently, so that's even a more significant level than before, but I still have the yellow line at 16133. That's really where I just start to get kind of meh, maybe start scaling out of short positions there, because if they pop that again, I think they can run it to the up to and probably take out the previous highs, and then we'll just have to address things or assess things and see how the charts look if and when that happens. But wouldn't be doing the video and making it clear if I didn't think that's what's going to happen. So all right, let's move on and go to ES, the S&P 500 futures. Let's see here. Got that chart. I'm going through all my charts down below. There it is. That one I already gave you this morning as well. Uptrend line right there. Another check of it. But as I said this morning, we've got to break this, the bottom right here. That's about 4,600, and then that previous reaction low. So those will be your check marks 1, check mark 2, and take us down. Yeah, I'm not even sure that might have been an old target there. Let me see what I have on the 60-minute for you ES. I'm sorry, the 120-minute chart for you ES traders. See if I had any different levels. No, just really the trend line is probably the most significant. Yeah, take that out. Yeah, if you're an ES trader and you want targets, just drop me a line under this in the comment section below this post, and I'll work up some targets. Right now, nothing really jumps out to me. I've got a reaction high there and a major reaction low there, and that's just shy of 4,500. So that would be a minimum, an initial swing target for me there. Okay, and before I get off the equity markets, I'll move on and give you a few other trade ideas, including an update on the REITs, which broke down from that flag today. IWM, for you small cap traders, it's got big support here around 209. I mean, that is just a super well-defined trading range. It goes all the way back to the beginning of 2021. So you talk about some energy building. One way or another, this thing's going to break sooner or later. We already had the false breakout, aka bull trap, and divergent high. And because of the technicals, the divergence, everything else, that's why I favor downside break. And again, I don't have a single target. I will not be covering my swing shorts on IWM unless I see something very compelling on the charts of both IWM, the small caps, and the large caps. Otherwise, that's a swing short that I think is good for a drop of 18.5%. There's all kinds of leveraged ETFs you can use, and I don't mind the leverage on the index, especially because I think it'll be a relatively straight down drop with not a lot of counter trend rallies. So TWM if you want to go 2-time leverage, or you can do TZA if you want to juice it up to 300% leverage. And I've always talked about it. There's so many articles out there that criticize these, saying they're the scourge of Wall Street. You should never trade them. And I agree with that. Buy and hold. The decay is going to chop you to pieces. You don't want to be. The absolute worst case scenario for trading, well, other than being against the trend. In other words, if you buy a bullish 3-time ETF and the trend is bearish for a long time, that's obviously the worst case scenario, of course. But right here, even if you're early on your call, let's say you got bearish right here on IWM, right, and called a top. It was darn near the top. You had a marginal new high, but it's been over a year now, and it's gone sideways. This is where the decay eats at your returns, and I explain it. It's simple math, and that's explained on the FAQ page in the site under ETF related questions. So where am I going with that? But if you break down, and it is a fairly what I call unidirectional drop, meaning not a lot of this here, this, that, but mostly straight down with not a lot of green days in there, then you can outperform. In other words, you can do better than 300% or 3 times the drop. Because that leverage then works in your favor. Once again, that's explained in the FAQ page. All right, so that's another trade idea for you. Watch it. We're right there. This is a daily chart. There's your level. It's about 208.50 on IWM. And again, this is what I'm talking about. And I know I'm beating a dead horse here, but we're in close proximity to breaking down. There is zero risk of a breakout to new highs if you go home short on IWM. But there is a measurable or substantial chance that IWM could gap down. All we have to do, that level is only 1.5% below. Futures tank. When the futures tank, it's usually about a 3% down on a bad weekend where something happens. The futures start going down. That's usually, from my experience, what you see, give or take 3%. So you could gap down below there, and if you did it, then boom, that's going to trigger a sell signal, and then they could just build on that from there. And that's again that scenario that, to me, one of the most bearish scenarios, because for the reasons I said, what happens is a lot of longs, they get trapped in there. Maybe they don't have hard stops, they have mental stops, and they refuse to take a loss on a 3% gap down. They want to wait for the kickback rally. Well, that's where it often never comes, and then you get all those you start to get a lot of trap longs, and they eventually will capitulate. And you also then have the shorts that don't jump in right away. And why is that? Why is that a good thing? I like to be the only one when I'm long a stock. I want everyone else to be bearish, or when I'm short, if ideally be the only short, only person short. Why? Because if everybody shorts a breakdown, if it's so clear and obvious, let's say we just start going down through there, and we break support, and it's just a green light for everybody, because who can't see that level? So a lot of eyes are going to be watching it. Well, then what happens is the short interest spikes. All of a sudden, you have a high short interest, and then that's a recipe for a short squeeze. That's what happened to AMC and GameStop. That's why those meme stocks, those Reddit traders, were able to zero in on companies with a high short interest, and you know what happened when shorts get squeezed out. So anyways, that's again why I talk about all these scenarios, and it's just big ifs. Look, we may never break down, we may do this, but you got to be ready. You got to have a game plan. You got to react. And so, maybe partially short. And if you get that gap down, at least you're profitable, and you don't mind then shorting let's say, hypothetically, again, a 3% gap down on Monday. Okay, I'll get off the markets because I know some of you are probably tired of hearing about all that. IYR update there. One of several sectors. Financials I also like as a short. I like that because, my gosh, everybody's been bullish on every article I read lately about the financials because the rising interest rates are bullish. But I'll get to financials in a second. But IYR, I gave you guys recently a bear flag. We shorted it in here before the flag set up. And then most recently I showed you right here, you had a bear flag pattern. I said you want to see an impulsive breakdown, which you had. That is your sell signal. However, we do have a BOD level, benefit of the doubt, and that's the primary trend line. So I would give a higher weighting to this trend line than I would on the bear flag, only because you have so many reactions. So we're talking a multi-year trend line with numerous distinct reactions. And we hit it the other day, and it held. But what's different this time, and this is why I think it'll break down. I think you could short right now on the breakdown there, and short again if the trend line's taken out. What's different this time around? Well, look, every other time you hit it, boom, one and done. Kiss that trend line, and that's where you wanted to buy. And that's what you want to do in an uptrend. Simple stuff. When you recognize a bull trend or you're bullish on something, you buy pullbacks to support. And if you did that, each and every time that trend line was hit, well, guess what? You made a lot of money, right? Now, this time it's a little bit different. We hit it, and the buyers, as they would, like Pavlov's dogs, ring the bell, the dogs salivate. They think the food's coming because he conditioned them that way. And then he was correct in conditioning. When you ring the bell, the dogs didn't come. I mean, he didn't put the food, but they still salivated. Well, guess what? If he kept ringing that bell, and every time they came running over to the food trough, and there was no food there, sooner or later they stopped coming. And that's what in a trend, that's what needs to happen. So when the buyers stop stepping in and buying the dips, that's when you have a change of character in the market. So let's look for that. But again, we'll only know in hindsight, but we're going to have an early clue. We already have one clue there, but that's not the end of the world. Sometimes you hit a trend line, you'll come back test again. But if that trend line goes, that's going to give us another check mark. So here it is. We had a check mark the other day because I put this on as an aggressive short, but I felt strong enough that I think it was a short entry here. Check mark number 2 is today on the break of the bear flag, and check mark number 3, and probably my last check mark, will come on a break below that solid break, especially the daily close below the trend line, and that's going to take us to our first target here. Unadjusted targets, actual support level, you want to cover maybe a hair above that. You also have your 200 days right there, 200-day exponential and simple moving average, and then 104.47 your second target, third target, current final target. And on this one, I told you I like SRS. You can use, there's a 3-time, I don't know if it's still around, it used to be gosh, I'm trying to remember, DRV. Yeah, it's still there. GRV, that's 3-time. But just feel a little better with SRS on this one, and so I gave that to you guys as the a proxy for it. So you can get that 2-time leverage, 200%. But if you want to use DRV and get 300% leverage, fine. If you think it's going to be a pretty straight down drop, then you'll outperform. Otherwise, here's your targets for SRS. Remember, we already hit the first target there. 1341's been hit, so now we just need to break that level. It was resistance and still is. We had two near perfect tags of it. So pop that, pop the trend line. That's going to take us up to my next target there, about 1468, then 1588. And even from where we're at today, I got to go a little, well, from where we entered back here, right? Somewhere in there. That'll give us, and this is my current preferred target right now. And that's about 25% gain. These are just a longer term rough target zone if things get really ugly. And you know what, let's just wrap it up here. This video is long enough, 26 minutes. I'll get this out to you. At least it's a thorough update on the equity markets, my thoughts for whatever they're worth, as well as, more importantly, some key levels and developments to watch for. So let's see how we close the day. And if we close the day where they leave us guessing, like I said, they're going to, no matter what, we're going to be much closer to the bottom of the recent range than to the top. But if they park it up somewhere back above, again, the level here on this daily chart, or we'll use the 60-minute chart. This is the level here, about 378.44, and we're a hair above it right now. If they park it up here somewhere solidly up there, then that keeps us guessing. And at that point, I wouldn't be adding, getting too aggressive over the weekend. I'll still certainly go home short, as I said. But and if they come down here and park it down here or here, I might go home even a little more aggressively short than I am right now. All right, we'll wrap it up here. And if I see anything else, I'll get it out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.